Today, I want to give you a clear, honest, and very up-to-date snapshot of what's really happening in the Tel Aviv property market. Because Q3 of 2025 was not just another quarter, it was a turning point. For years, Tel Aviv has been one of the hottest, most competitive real estate markets in the world. Prices went up, and then they went up again, and then they went up some more. But this past quarter, we saw something we haven't seen in a long time, a real correction. According to official CBS data, the average Tel Aviv property price fell to 3.68 million shekels, a 13% drop year on year, and 12% in a single quarter. Across the wider Tel Aviv district, prices dropped 7.6%. This wasn't a minor adjustment. This was the market stepping back and saying, enough. Now, why did this happen? Several forces collided at the same time. Interest rates have been sitting at 4.5%, making mortgages significantly more expensive. Security tensions in June shook confidence. And something critical. Israel is sitting on a record 83,920 unsold new homes, representing 28.8 months of supply. When developers have that much stock, the pressure is enormous. But here's the twist, and it's one most people miss. Even though prices fell, transactions actually went up. Nationwide sales increased 15.4%, new home sales jumped 23%, and in Tel Aviv, new build sales surged by 53% in just one quarter. That tells us one thing: buyers are coming back because prices are finally becoming realistic again. Another fascinating detail: not all apartments moved the same way. Large family-sized units, the 4.5 and 5-room apartments, fell harder than anything else, dropping 26% from earlier this year. Meanwhile, small units, studios, and one-bedrooms actually rose in price. So what does that mean? It means the premium segment is hurting, but entry-level demand is alive and kicking. And across the country, the picture isn't uniform either. Jerusalem, Haifa, and the north all saw price increases, while Tel Aviv, after years of nonstop growth, is simply correcting to where the market should realistically be. So, where do we go from here? The next phase depends on interest rates, security stability, and how quickly the huge inventory backlog gets absorbed. But right now, we're not looking at a collapse. We're looking at a market reset, a natural cooling after years of overheating. And resets, by the way, create opportunities. For buyers, this may be the first genuinely favorable moment in years. For sellers, alignment with the new reality is essential. And for investors, strong rental demand and improving yields make this a market worth watching closely. Bottom line, Q3 2025 wasn't the end of anything. It was the beginning of a new, more balanced cycle. And understanding that shift is how you stay ahead of it.